We're on. Good morning, folks. Let's do it. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. It is Thursday, March 9th. I'm your host, JD Durkin. We're about an hour or so into trading. Stocks are up across the three major indexes as we speak, as investors continue to react to comments from Fed Chair Jay Powell and, of course, gear up for tomorrow's February jobs report. Did you know tomorrow's jobs report day? Of course you did, because we've been talking about it all week and we are far too excited for it. On the show this morning, we will talk central bank as investors continue to assess the Fed's next move, 50, 25, who knows. Plus, we'll talk jobs as Wall Street reacts to higher than expected jobless claims, as well as braces for that jobs report tomorrow at 8:30. We'll get the print from Bureau of Labor Statistics. And finally, we'll tell you why crypto bank Silvergate, it's a good one, is on the verge of shutting down. A good story indeed. For more on these stories and so much more, let's bring in our special guest for the morning. Alessio de Longis is Senior Portfolio Manager at Invesco. Very happy to say he joins us here on set this morning. Good morning.
Good morning. Thank you for having me.
It's great to have you here. Of course, we talked an awful lot about Powell's commentary earlier in the week. Jay Powell has been very clear to say there's a lot of data points that we are expected to get between this week and when the FOMC meeting happens again in March. What did you make of some of the comments we heard from Powell, even just the last couple of days on Capitol Hill, I wonder?
I think his objective was to show his audience and U.S. Citizens that they are very sensitive to the data, that they are not on a preset course, they're not on a preset path, and they are going to respond to what the economy is telling us. With that being said, it would be odd to expect that anything that happens between now and next week can actually derail the plan for the long term. So I think the Fed is on course to continue raising interest rates. In our opinion, 3 more hikes by 25 basis points would be consistent with that softer pace after the major increases that we've seen before. 3 more hikes, while at the beginning of the year we would have thought maybe 2. The reality is that inflation is not slowing as quickly as hoped, and most importantly, the unemployment rate not only is not rising, actually continues to fall. So the data, the evidence is telling the Fed that tighter for longer is required. It requires a lot more timing than we thought we would require to slow the economy.
I'd have to imagine you are not expecting another monster 517,000 type jobs report tomorrow morning like we were all surprised by this time a month ago.
It was an incredible outlier. Some of these reports do carry every once in a while some unexplained seasonal effects. There was probably a weather effect. We expect something closer to consensus with the potential for maybe a softer print. But the real interesting data point will be to see how that top line number interacts with the unemployment rate, with the participation rate. Is the labor participation rate going to rise? Is that going to affect the unemployment rate? That's really what is the most important from a Fed perspective.
You mentioned that it sounds like your base case here is more or less 3 consecutive rate hikes at 25. We've seen the CME Group FedWatch number go up statistically a bit higher here in recent days since Mr. Powell started speaking to the Senate to give us an indication. Some people now think a lot of people apparently think 50 basis points is back on the table. Do you see that? How strong of a possibility do you see that? Even given that it would mean perhaps it would signal a bit of a policy error by the Fed to now kind of go back up.
Yes, I think you're hitting the nail in the head in what the trade-off from the Fed thinking could be, right? The communication is very important, forward guidance is very important. They spent last year signaling the slower pace of interest rate increases, and the moment you start printing 25, it's very difficult to go back to a 50 with no follow-through, right? I think from their perspective, the stability of the communication is more important. Raising 50 now, again, would require a very strong message that, hey, this was kind of like a one and done, as you said, a bit of a making up for a policy error. I don't think that that's a wise decision, especially because 25 basis points in their scheme of things, we've reached from 0 to 5%. What is that really going to do?
Do you think Chairman Powell follows the markets closely? And if he does he really care?
I think it does follow the market in terms of the market is the best real-time barometer of incoming economic information. The market, not just the stock market, the interaction between the stock market, credit markets, high yield, investment grade, government bonds. Market prices are your real-time proxy of what market participants expect the economy to do. It's his pulse, it's his check with also his job. Is he targeting a level in the stock market or is he targeting levels in asset prices? Absolutely not. but the market is a better growth forecaster than 100 PhDs in an economics department. It's an interaction.
Yeah, absolutely. To the point about the Fed Beige Book we got yesterday, it gives us oftentimes a bit more of a regional read. What stands out to you as we do get those readings? I think we get 8 of them or so a year. Any kind of key information either you learned this week or that you look for in general when the central bank releases that?
We haven't noticed anything particular. I think what is interesting in my mind at this stage in the cycle is through these reports at the regional level is to really understand how that policy tightening is filtering through the different sectors. First of all, as expected, housing is weakening. Housing market, construction, these are the sectors of the economy that are most sensitive and most reactive to policy tightening. And with the spike in mortgage rates, that's what we expect to see. That is the first leading indicator into the future, followed by manufacturing, followed eventually by services. And the reason why the unemployment
eventually
rate is so
by services, yeah.
The last one is
Right,
services.
right.
Is the less cyclical, but services is the bulk of the employment. So you see this, the interesting read in these reports is to start having an understanding, is policy tightening having an impact on the economy, even though I'm not seeing in the top line unemployment rate.
Anything else here in the general conversation of the Fed, Mr. Powell, the challenge ahead for the central bank that you and I did not already explicitly talk about that's pretty important to you that you might want someone watching to keep in mind as we head into these next few weeks, and they are very crucial weeks at that?
Yeah, I think we always have, rightly so, a focus for the Fed and the U.S. economy because the biggest chunk of capital markets. But for investors, and when you think about your portfolios, I think it's an interesting data point is to see that international equities are actually behaving in a much more resilient way than we would have expected, especially Europe, which was at the epicenter of the Russia-Ukraine conflict and the energy shock. The resilience that we're seeing in the cyclical rebound in Europe and coupled with the China reopening, that's something that investors should take a look at after 15 years of dominance in US asset classes. Keeping an eye to the topic of diversification to global markets, it's something that could persist in the long term.
Are you in the camp now of a potential soft landing, a no landing, somewhere in the middle? A hard crash landing? We keep having this conversation about how the central bank tries to land this airplane, as difficult a task as it is.
Yes, we're still in the camp of a soft landing. Soft landing may require a recession, but a mild recession. We, in the last 20 years, have only experienced cataclysmic recessions such as the GFC or the pandemic. A normal cyclical adjustment is what we expect.
Normal cyclical adjustment. All right, well said. I'd like to ask you about some jobs data. If we can, we did get jobless claims here. They come in at 211,000, higher than the forecasts of about 195. What do you make of those figures?
The figures would be consistent with a non-event and would be consistent with unwinding some of the strength that we saw last month. They would be consistent with 3 more hikes at 25 basis points, I would say.
Of course, big jobs data out tomorrow. We got the top line number we follow, unemployment, you and I talked about a bit earlier before we came on air, and of course, average hourly earnings. Give me either your hope, your expectation for what we get tomorrow, and of course, what does the Fed hope that we see tomorrow?
The Fed hope is to see a monthly and quarterly increase in the wage growth, but at a much slower pace. If we begin to see 0.2, 0.3 monthly increase in the wage pressure, I think that is the annualized number, that the annualized version of that, basically wage growth at 3% on a yearly basis is what the Fed would really want to see in order to start taking the foot off the pedal, and that's what the market would really, really welcome. If we get another monthly increase north of 0.5%, it's still too high.
So to confirm just on wages, still going up, but just taper off that pace a little bit.
Yes.
You think that's the sweet spot for the Fed?
Yes.
For average
absolutely.
hourly earnings. And then unemployment, you and I were talking about it a bit earlier. I mean, I don't know how many people saw the number coming in at 3.4 last week, but of course, as that number comes down, you put more upward pressure on wages. So how does this translate in terms of the challenge of now trying to, as scary or counterintuitive as it may sound, trying to gently raise that figure north of 3.4%?
The message is clear. Right now, good news is bad news,
Yeah.
right? Good
and it
news
has been for a while, kind of.
Good news
right?
is bad news.
It's
So,
strange, yeah.
what does the Fed want to see, and probably what the market wants to see, is an unemployment rate that starts ticking higher, but not a big jump.
Right.
Maybe an increase of 0.1%, 0.2%, back north of 3.5, 3.6 would be the sweet spot. Getting these kind of calibrations is extremely unlikely.
Yeah, of course. I mean, it really seems like a bit of an anomaly. We had seasonality played into last month's numbers, of course, with
Correct.
regards to the Fed's consideration. Right?
We're likely to see. I think that sweet spot can be hit this month. It doesn't provide any guarantee for the future, right? In general, you see that it's practically impossible to slow down the economy without raising the unemployment rate
I want to start with
by at
investment.
least 0.5. So in my mind, that takes us. We need to see the unemployment rate at 4%, 4.5%, to expect a meaningful downward correction in economic growth, if that's what the Fed is trying to achieve.
And now, of course, that was the subject of the, I don't want to say, kind of contentious back and forth with Senator Elizabeth Warren and Chair Powell a few days ago.
Correct.
I personally, I found it kind of hard to believe that the chairman does not know the number of Americans who would be impacted. I feel as if he probably just didn't want to say it. Yeah. But, that the number that the senator is going with is 2 million Americans, saying basically if you're successful of meeting your pre-year established target, your forecast of 4.6% unemployment, you're talking 2 million Americans out of work. And many of the lawmakers this week were gravitating towards, what is your message? What do we do for these most vulnerable veterans, et cetera, who will be on now more and more out of work, even if that means the cost of inflation. I mean, it was a pretty amazing exchange there, and then it happened with a few more progressive lawmakers in the House yesterday as well.
It's a very delicate exchange because you almost there's no way of walking out of it in a successful way.
Right.
Let's think
There's no
about,
winner. Yeah, it's lose-lose kind of.
If you raise the unemployment rate, you're affecting 2 million Americans. If you do nothing, you're affecting millions of Americans with rising inflation that is effectively a tax. It affects their standard of living anyway. So I think that exchange, we should not forget that it requires two sets of policies to solve this problem. It's not just monetary policy, it's also fiscal policy. So Congress should address selectively pockets of the economy through fiscal support in order to manage this transition as well. But the Fed is tasked with, first and foremost, inflation. I know we have a dual mandate, but it's actually, interestingly, the only central bank in the world with a dual mandate. Or other central banks in the world only have a mandate on inflation.
Right.
Precisely because the two mandates are often incompatible with each other.
Absolutely. Maximizing employment and stabilizing prices. Right? I mean, how many first-year economics students learned pretty quickly? It's like, oh, those two things are not necessarily compatible. Yet that's the established goal of the Fed. That's a tough challenge, right?
The goal is to have your cake and eat it too.
Yeah, exactly. Only in the United States, right, do we have a system like that. You and I, before we came on air, we talked briefly about the JOLTS data. It oftentimes is subject to criticism for many reasons, one of which being it doesn't really cost a company to put up a job posting and to leave that job posting up. Even if you maybe don't really need to fill that job, that may feed into that data that the central bank is then taking into consideration. Any takeaway from you yesterday with regards to that number, and how should we look at a number like that, maybe even if it is with a bit of a grain of salt?
Look, I think there is always statistical noise and inaccuracies in all the statistics that we use. I think the point that you raise is a valid one, especially survey-based data carry a large degree of subjectivity. The point that you made about the quality of job openings and the validity of those job openings can be questioned. I think by and large, the direction of the data is still very helpful. The order of magnitude, let's not overanalyze the data to the last decimal place, but the order of magnitude is telling. And I think it's important to square with the struggle on raising the unemployment rate today. We have spent a year now where the amount of job openings out there was 2 million north of the available pool of applicants of the unemployed, which tells you how much spare capacity we could absorb with this policy tightening. I think the reason why we're not seeing the unemployment rate rise, and we're still early in this policy cycle, we only started raising rates a year ago, usually takes about 12 to 24 months to feel the impact of monetary policy tightening. I think those job openings are becoming a rarity compared to 6 months ago, and only then firms will start tapping into into the employment situation. So I think the data should still be taken with a grain of salt, but it's still relevant information. There's still spare capacity in the economy, and I'll be curious to see how the participation in the labor market,
labor participation rate,
that's key. We have not returned back to the pre-pandemic levels. And that can create some additional downward pressure on inflation.
We've been asking for quite some time openly. It's kind of become a bit of a joke. We say, where are the workers? Where are the workers? But to our point about one of these big challenges for the Fed, I assume your expectation is that would become a bit more clear once we begin to see that unemployment figure begin to jostle up a little bit, right? I think the dust would finally start to settle on that question, maybe?
We often confuse structural themes for cyclical themes. I think as inflation has risen meaningfully, and that is denting on consumers' ability to meet month end, and we start walking out of the pandemic shock and the need to stay home, the need to rebalance your quality of life with certain needs, the return to work, the return of the workers will become incrementally more evident as the cycle progresses, in my opinion, which should help bring inflation down.
Absolutely. Anything else on some of these lagging indicators in particular that we're talking about, whether prices, employment, whatever it is, that you and I did not talk about that you would want to stress for anyone watching?
No, nothing in particular. I think the realizing that the service sector is very diverse and very non-cyclical. It tends to respond to the tightening in monetary policy at the very last moment. I think the service sector responds to the stock market, responds to the price action in markets. It's that confidence effect. While policy tightening right now is working definitely on housing, on construction, on the longer dated economic sectors that require long-term financing.
Right.
We need, I would say, let's brace for a rate of growth that remains low, but there's no need to fear a recession like the ones that we've gotten accustomed to in the last 20 years. The system is much more stable, much more balanced. The leverage in the system, the amount of debt in the system, especially in the private sector, is much more healthy and at a sustainable level.
Yeah, and to that point of overall GDP growth, we know that Mr. Powell and his colleagues are going for below trend growth, essentially below that Goldilocks zone of 2 to 3%. It doesn't seem as if, at least given the current forecast, we may be quite there. It seems like we're kind of in what's normally good news, but since we're in this weird upside down world where a lot of good news is bad news, a print for GDP north of 2% may not really be what the Fed wants, right?
No, I think the Fed wants sub 2% growth for a prolonged period of time. In their models, that feeds in as a necessary condition to see the unemployment rate rise.
Right.
So that's what we need to see. That soft landing zone is 0 growth, 1% growth. That's the soft landing.
Yeah.
Or some modest negative GDP growth. Let us not forget the first 2 quarters of last year,
yeah.
We had negative. We basically had no growth in the first half of the year, and here we are. The unemployment rate hasn't moved.
Right, and then we skyrocketed in 3,
Correct.
Pretty much, and then 3 and 4 much more normal levels. And for all of the talk to say, we're clearly in a recession, right? That's the definition. 2 consecutive quarters of negative GDP growth. I think that very quickly, by the time we got to Q3,
didn't feel like it.
Everyone's like, what recession, right?
Correct.
You're kind of looking around at the rest of these metrics, kind of scratching your heads because this is no normal economy. The normal data points don't, and we didn't even talk about bonds. Actually, let's talk bonds quickly before I get to these general questions. For all the talk of the inverted yield curve, the most reliable indicator of a recession, there are concerns you have these distortions in the bond market because of the Fed's efforts on QE and QT. But as Mr. Powell spoke earlier this week to the Senate, we really saw that 2-year shoot up north of 5% for the first time since 2007. And this inversion is the steepest it's been in many years between the 2 and the 10 benchmarks, right?
You're raising a very, very crucial data point. If there's one variable to continue look into the market is that inversion of the yield curve, both on from Fed funds to 10 years or 2s, 10s in the yield curve. You're inverted now by about 100 basis points. In the 70s and the 80s with the inflation shocks, and we did not have inflation targeting, we got to minus 150. So this is uncharted territory under inflation targeting regimes, right? So this is a meaningfully inverted yield curve which will continue to exert upward pressure on credit spreads, upward pressure on mortgage rates, because it's evidence of financial tightening, right? And I don't think that the distortions in the bond market are diluting that message. The message is there, right? Yeah. In other words, as we were saying earlier with survey data, yeah, maybe the distortion is to the extent of 10, 20 basis points, but the distortions are not causing the yield curve to be inverted, right? The yield curve is inverted because the Fed wants it to be inverted. They have jacked up interest rates in the short end, the 2 years at 5%. I mean, we have not seen this level of income available for our portfolios since 2007. It is actually a golden opportunity. For the last 15 years, we've been starving for income, searching for income everywhere, and moved out to riskier segments of the stock market to harvest returns. You can now effectively decrease risk in your portfolio, move into a larger portion of your allocation to high yield, to investment grade. In investment grade space, so AAA or north of BBB bonds, you can harvest 5-6% yields. In high yield space, you can now harvest 8-9% yield. This mid to high single digit returns is the long run expected return on stocks. So you can now achieve equity-like returns in broader fixed income markets with far less volatility.
Essentially without the risk, right? I mean, in terms of especially some of these treasury notes and these benchmarks, I mean, it's an incredible conversation. And so I appreciate the perspective because we did see so much movement there in those yields over the course of the last few days. And so thank you for letting me be able to bring that up into our conversation. I meant to do it earlier and I forgot. A few here kind of more general investing or kind of market questions to wrap up our interview, if you don't mind. People are looking at where is the buying opportunity, right? We always say buy the dip, where are the lows? We're not that far off from the 200-day moving averages across the three indexes, but for people who are wondering where these buying opportunities are, really when they are, what would your answer to that question be?
So on the equity market, I would really wait. I think we are coming from a very impressive rally in the first 2 months of the year. Just simply analyzing that makes it unsustainable, right? So I think it's not the time now to add to equities. I would say, given that government bonds went back up to 4%, maybe not necessarily buying government bonds, but again, this is a great opportunity, in my opinion, to shift more capital into equities, into fixed income, per the yields that we talked about earlier, because if and when the cracks in the economy come and the Fed signals the end of the tightening cycle, those opportunities are going to evaporate very quickly. Where there is a buying opportunity that we haven't seen in 15 years, in my opinion, is rebuilding a healthy income, fixed income profile in the portfolio. Doesn't mean that we don't own any equities, but in a broad diversified portfolios, in a broad diversified multi-asset portfolio of equity, credit, and government bonds, in the last 15 years, the Fed pushed us out to equities. They said, we're going to buy all the government bonds. I'm going to take yields down to zero, so you are forced to buy equities. Now they're clearly signaling the opposite. Rates are going up. Yields are becoming more attractive. Bonds are becoming more attractive. I think that's the buying opportunity in my mind.
That is, of course, until or unless the Fed is successful and it does orchestrate more or less of a recession and it realizes, okay, now we need to drop rates back down. Then this whole conversation changes, but who knows when that is?
And that conversation will change, and it will be a great time to buy equities again.
Right,
but
and then you go back
yet.
to your riskier assets, and we're not there yet, and at least the recent data points have shown us it may be quite some time before we're there. This time next week, after CPI, PPI prints, after the jobs number Friday, it may be a different conversation, but that's great to see. That's the beauty of having this conversation with you on Jobs Report Eve, is that we can kind of have these conversations not quite yet knowing what the numbers are. Talk to me about some of your tried and true investing tips that you've carried over so far into this year.
Stick to your discipline, stick to your plan. The biggest lesson in my mind is we get lost with extrapolating. When we cannot explain the short term and there are anomalies, we tend to explain that this time is different. New structural things that are making the data or the old-fashioned way of rationalizing things not appropriate. That is never the case. The reality is that most of what happens is often cyclical, and sticking to that discipline is very important. What is that discipline today? The unemployment rate is at all-time lows. This cycle is extended, right? The Fed is tightening rates. The yield curve is inverted. What have we learned time in and time out in history about what that means? It means it's time to get a little bit more defensive. That to me is the most important investment tip, to stick to the discipline.
I love it. Thank you for that. Finally, I know you cover some of the sectors very closely. Are there any sectors you think right now that are more attractive than others?
So one way to build defensiveness in the portfolio without selling equities is, for example, to reshape the exposures within your equity portfolio. So I think it's appropriate to reduce exposure to cyclicals such as financials, industrials, materials, building a little bit more exposure into the defensive ones. Healthcare, staples, the boring sectors, right? Healthcare, staples, utilities, but frankly, I think communication services and technology have defensive characteristics. Good quality technology companies with very large profit margins, monopolistic positions, the large tech companies, now that their valuations have come down meaningfully, they carry those quality characteristics. Their role of being dominant players at a better price is clearly a defensive characteristic. So those are the sectors that we favor at the moment.
All right, Alessio de Longis, Senior Portfolio Manager at Invesco. Very happy to say our special guest for an awesome conversation today. Thank you so much for taking the time.
Thank you.
I always like to say to good guests, thank you for making us all smarter together, and we went through so many topics, and I know that that's the case today, so thanks a lot for being here.
Great questions, a great conversation.
A great guest, great to have you. We'll do it again soon, hopefully. Thank you a lot. All right, folks, coming up here on the show, we will be bringing you the latest headlines on Biden's budget proposal and yet another crypto collapse. But first, I sat down with my good friend and financial literacy expert, Ross Mack, to discuss investing do's and investing don'ts. Take a look. I want to start with investment do's and don'ts. A lot of investors, maybe first-time investors, are watching this interview from the outside saying, I don't even know where to begin. Yeah. What is some early advice you might give to an investor like that, considering getting involved with the game?
Well, one, I would say temper your expectations. I think we go on social media. The vast majority is everybody's getting rich quick, right? I don't know if there's some meme stocks or Reddit or whatever, but I think at the end of the day, be disciplined, be consistent. And I think you want to actually start out by budgeting, because I don't think, the philosophy is to let me start off with $1,000 and try to make $1 million next year and I'm good to retire, right? The idea is getting rich, but over time by being consistent and disciplined. So by starting out with the budget, you actually know how much money you could actually invest on a monthly basis. And from there, I'd start off with the most diversified portfolio possible, starting off with index funds. And if you want to get deliver some alpha, right, you could say, which stocks I actually want to single-handedly select. But I think by starting out being diversified, having the right mindset and temper your expectations, I think you'll be good.
How important is, especially for a first-time investor, to do their homework before they even throw any money into the game, right? To make sure that they are dotting their I's, they're crossing their T's, that they could say, I'm making an investment, yes, but I'm doing so from an educated point of view.
I think it's very important, right? I think a pitcher doesn't go out there on the mound without at least warming up, right? What people need to understand is investing is professionals, right? Obviously, we're sitting here trying to, build wealth through investing, and a lot of people are doing it passively. But for the people that are trying to actively invest, trading stock options, trading futures, and, day trading, etc., you got to understand that you're going against true professionals that are controlling trillions of dollars of capital, right? Some of the top institutional security funds. And so what you have to ask yourself is, if I'm going in a game with LeBron and I've never done any homework, he's gonna score 90 points on me, right? Sure. And so I think it's very important to do your homework, because you don't want to get out there and lose your money, and as a result, you find yourself saying, I never want to invest again.
Let's talk crypto specifically, because this has just been a world that's been on fire, and you're talking about wild volatility, upswings and downswings as well. And I think that's something that a lot of investors say, I don't want to be on the outside looking in. There's a lot of FOMO that happens in terms of especially the big coins that are trading. Where do you advise people start, even if that's in terms of doing your crypto-specific homework? They're saying, hey, a name like BTC or Ethereum, I want to be involved. I don't even necessarily know where my emphasis should be.
Almost the same way we think about first investing in the stock market, right? How do I get a hold of the best companies? So the first thing we say is, let's get the S&P 500. You're going to have 500 of America's best companies. I think you want to have the same concept, right? The same strategy when you're going to crypto. And that is, how do I get the best cryptocurrencies. Obviously, there are thousands of cryptos. I want to say like over 5,000 right now. Even be more, right? The idea is saying, one, let me understand what I'm investing in. Let me do the homework. The same way, we're not getting on the mound without taking some warm-ups, right? But at the same token, you want to say, what does Bitcoin do? What does Ethereum do? And if those are the two best, let me own a little bit of it. Once again, we're scaling in, we're dollar cost averaging, we're buying a little bit on a monthly basis, but also you got to understand what your risk tolerance is. If you're 70 years old and you're trying to retire tomorrow, or better yet, if you're 60 years old and you're trying to retire tomorrow, I'm not telling you put 100% of your portfolio in Bitcoin. Absolutely not. It's one of the most volatile assets in the world. Crypto is one of the most volatile asset classes, right? So what you're saying is be truthful with yourself. What is my risk tolerance? What is my investment horizon? And from there, now you're saying, okay, my overall portfolio allocation, maybe I want to put 5 or 10% in crypto, because you have to understand it is very normal for crypto to go down 50%.
All right, my special thanks there to the great Ross Mack. It's time now to get you caught up on a few of the big stories that we're watching for you at the street. First up, President Joe Biden set to unveil his 2024 budget proposals. We're expecting that announcement later today, and a plan that would increase taxes on investors as well as the wealthiest Americans. The president says the proposed budget will look to reduce the deficit by around $3 trillion over the next decade. The plan includes a handful of taxes on top-earning Americans and closes the loophole that allows big hedge fund managers to pay lower taxes. The White House also proposing additional taxes on Medicare and Medicaid to help keep the program afloat. The proposed budget is considered dead on arrival, meaning it's not expected to pass in the House or the Senate over on Capitol Hill. Sticking with the world of politics, Senate lawmakers looking to revive a bill that would pressure the OPEC oil production group to stop making output cuts. The so-called NOPEC bill, or No Oil Production and Exporting Cartel bill. They love their acronyms on Capitol Hill. The bill would remove the sovereign immunity that has protected OPEC from antitrust laws for years. This attempt comes after several failed attempts to hold the group more accountable for their anti-competitive behavior. And finally, another one bites the dust as the broader crypto fallout continues for many names. Silvergate Bank, one of the main lenders in the crypto industry, has announced plans to officially wind down operations and to liquidate its bank. Silvergate, which held just over $11 billion in assets, said that all deposits will be fully repaid to its customers. And this collapse comes as no surprise. The bank has been on the decline for a while now. Just earlier this week, the company shut down its payments platform known as the Silvergate Exchange Network and also laid off 40% of its workforce back in January. This news sending ripples throughout the crypto market. Both Bitcoin and Ether are down over 2% this morning. That'll do it for The Street Today. Once again, my very special thanks to our special guest, Alessio de Longis, Senior Portfolio Manager at Invesco, for joining us here in person this morning, here from the floor. And stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.